Baoshang Bank, with its saga of corruption, a dramatic downfall, and a significant role in the changing financial panorama of China, is a riveting tale of corporate tragedy. What sets this story apart and etches its mark in the annals of finance history is the dramatic irony of it being China's first bank failure in several decades. The gravity of the situation was so intense that it pushed the Chinese government into a crisis mode, prompting an injection of over $125 billion into their financial system to prevent a domino effect that could potentially cause a wider financial meltdown. This compelling narrative necessitates a journey back in time to understand its roots and explore its broader implications. To comprehend the magnitude and uniqueness of Baoshang Bank's story, we need to understand the environment in which it unfolded. China's banking system is characterized by its stability, bolstered by a combination of strict regulation, government support, and a generally conservative approach to risk. A bank failure, let alone one that necessitated government intervention, was practically unheard of, marking Baoshang Bank's collapse as an anomaly in China's modern financial history. To begin, let us take a closer look at its journey. Early on, it was established in the Inner Mongolia Autonomous Region in 1998. Initially, it was a relatively small entity, but over the years it expanded dramatically, becoming one of the leading commercial banks in the region. Baoshang Bank was known for its aggressive expansion strategies. It extended its reach beyond Inner Mongolia to different parts of China, opening branches in places like Beijing and Shenzhen. It worked on attracting a broader base of depositors, offering high interest rates to pull in funds. And once it had these funds, it didn't hesitate to lend aggressively. Loans were given out to a variety of businesses, including those that were part of the vast empire of the Tomorrow Group, a conglomerate controlled by billionaire financier Zhao Jianhua. At the time, Baoshang Bank built a reputation for innovation. It was one of the first city commercial banks in China to undergo a mixed ownership reform, where state and private capital were combined. It was also one of the first of its kind to introduce internet banking in China. In 2005, a significant shift occurred when Tomorrow Group started to invest in the bank. Through a series of purchases via different entities, Tomorrow Group amassed a controlling stake in Baoshang Bank, despite rules that limit a single investor's stake in a Chinese commercial bank to 20%. This was possible because the purchases were made through a number of different corporate entities, obscuring the overall size of the Tomorrow Group's stake. With Zhao Jianhua at the helm, the bank continued to grow, reaching a staggering 576 billion yuan, or $83 billion in assets by 2016. For comparison, this was larger than many national banks in other countries. Baoshang became a significant player in Chinese banking landscape, with reach and influence that extended far beyond Inner Mongolia. Baoshang Bank's rise, however, was not without red flags. Analysts noted the bank's extraordinarily high profitability rates and the substantial amount of wealth management products it offered, both of which suggested a high-risk approach to banking. The bank's close ties to Tomorrow Group and Zhao Jianhua also raised eyebrows, especially as Zhao was known for his complex web of business interests and his close connections to political elites. But despite these warning signs, Baoshang Bank continued to thrive, and its downfall came as a shock to many. The bank's rapid rise and dramatic fall is a stark reminder of the risks and potential instabilities within the world of finance. It highlights the need for regulatory vigilance and proper risk management, especially in an environment where rapid growth and high returns can often mask underlying vulnerabilities. The downfall of Baoshang Bank was as dramatic as its rise. In May 2019, the People's Bank of China and the China Banking and Insurance Regulatory Commission took over Baoshang Bank for 1 year, marking China's first bank seizure in nearly 2 decades. This move sent shockwaves through China's financial system, prompting concerns about the overall health of the country's banking sector. The primary trigger for the downfall was the bank's risk management and corporate governance failures. These issues came to light following the disappearance of Zhao Jianhua, the owner of Tomorrow Group, who was reportedly taken from a Hong Kong hotel and brought into mainland China for investigation in early 2017. Xiao's disappearance and the subsequent investigation into his business dealings revealed a tangled web of high-risk financial products, questionable loans, and regulatory violations at Baoshang Bank. This drew the attention of Chinese financial regulators, who discovered that Baoshang Bank was far more exposed to risk than it had previously admitted. Further investigation into Baoshang's books revealed a staggering level of fraud. According to China's central bank, about 156 billion yuan, or $22 billion of Baoshang's assets, were tied to fraudulent transactions with Tomorrow Group. This represented nearly 40% of the bank's total assets. As these revelations came to light, the bank's financial health quickly deteriorated. Despite attempts to rectify the situation, the extent of the fraud made it impossible for Baoshang to recover on its own. This led to the unprecedented move by the Chinese government to step in and take control of the bank. The takeover by the government involved restructuring the bank's assets and liabilities. Small and medium-sized banks, as well as individual account holders, were protected by the government, while large institutional creditors had to accept a part of the losses. This downfall was not just the collapse of a single bank, but it exposed deeper issues within China's financial system. The event highlighted the risks posed by China's smaller banks, which often operate under less scrutiny than their larger counterparts. It also raised concerns about the potential for similar situations to arise at other small and medium-sized banks across China, many of which had pursued aggressive growth strategies similar to Baoshang. The collapse of Baoshang served as a wake-up call for China's financial regulators. It highlighted the need for improved oversight, better risk management, and more transparency in the banking sector. It also underscored the importance of maintaining trust in the financial system, particularly given the potential for a single bank's failure to spark broader concerns about financial stability. The aftermath of the Baoshang Bank collapse reverberated through China's financial system, prompting serious discussions about the vulnerabilities of the banking sector and the implication of these weaknesses for the wider economy. Firstly, the government's decision to allow Baoshang Bank to collapse instead of propping it up signaled a significant shift in China's approach to managing its financial system. For decades, the unwritten rule was that the Chinese government would always step in and bail out struggling banks to prevent any risk of contagion. However, Baoshang's bankruptcy declaration showed that Beijing was no longer willing to save every bank, and ready to impose a survival of the fittest principle in the sector. This signaled to both domestic and international investors that the era of implicit government guarantees was coming to an end. Moreover, the aftermath was characterized by a tightening of financial regulation. The Baoshang incident had exposed serious regulatory lapses, leading to a renewed focus on strengthening the oversight of smaller banks. Chinese authorities started to conduct stress tests on these institutions to identify potential risks and ensure that they had adequate capital buffers. Regulatory measures were also put in place to control the rapid growth of off-balance sheet wealth management products, which were partly to blame for the excessive risk-taking. Furthermore, the collapse had a profound impact on the interbank lending market in China. Baoshang's failure created a sense of uncertainty around the soundness of smaller banks, leading larger banks to be more cautious about lending to these institutions. This caused liquidity to tighten and the cost of borrowing to rise, particularly for smaller and less-known banks, which led to a significant slowdown in their lending activities. As a result, the interbank market saw a significant decline in activity, and the cost of borrowing rose sharply, particularly for smaller and less-known banks. Lastly, the incident served as a reminder of the importance of corporate governance and risk management. Following Baoshang's downfall, many banks in China were forced to reassess their risk profiles, tighten lending standards, and improve internal controls. There was a renewed focus on risk management practices, with banks increasing their provisions for bad loans and implementing stricter lending criteria. In conclusion, the Baoshang Bank collapse was a moment of reckoning for China's banking sector. It highlighted the systematic risks lurking in the financial system and led to substantial changes in regulatory landscape. Despite the economic turbulence it caused, the incident also served as an essential catalyst for reform and a stark reminder of the importance of sound financial practices.